Hey everybody, it's Mike from Orderflows, and in today's video, I'm going to reply to a question. I actually replied to it in the comments the other day, but this is a question I've gotten many times over the years, and I thought I'd just shoot a quick video explaining it, because this is a question that a lot of traders have is what type of chart should I be using? Sometimes I talk mostly about a time-based chart, like a 1-minute chart, or sometimes even a 5-minute chart. But I also look at range-based charts, and the way they're constructed obviously is going to be different. So in the video the other day I was talking about bonds on a 5-minute chart, and if you've been around long enough, if you traded for at least 10 years, you'll know that markets evolve, and now we're sort of in this time where things are a lot more volatile. In the past, going back to, this is an old footprint chart from 2015. This is the March bonds in 2015, and you can see you're looking at a range. This is pretty much the day's range. This is when I was still back in Asia, so it looks like midnight, but this is actually during the US day session. 141 even up to about 141.16 for pretty much the whole entire session, whereas now in the US, just going back to Friday, from, we'll take it from 8 in the morning, where's 8 in the morning here, more or less, coming in at 131 even, down to, 130 even. So and that's just within 2 hours. So, you're getting a full point move in 2 hours, whereas, years ago you would get a much smaller move. And, in the past, I focused a lot of my attention on range-based charts. And, the reason being, when markets are slower, the range-based charts, in my opinion, will pick up momentum a little bit quicker, right? Because the difference between a time-based chart and a range-based chart is how they're formed. A time-based chart, it just, if you're using a 1-minute chart, after 60 seconds, boom, a new bar is going to be formed, right? If you're using a 5-minute chart, 457, 458, 459, 5 minutes, boom, a new bar is going to be formed. Whereas a range-based chart is formed, how price moves in comparison to its highs and lows, right? If it's going to start moving, outside of its range, right? It's a range-based chart. And, there are pluses and negatives on both type of charts. I just explained one of the negatives with the time-based chart, in that it's, it's literally starts and ends at a predetermined time. That's it. Whereas, if you're looking at a range-based chart, when a number comes out, so for example on Friday, 7:30:01, 7:30:01, 7:30:01, 7:30:02, we formed, what is that, 4 bars within 2 seconds, whereas even up to here, 7:30:55 on a 1-minute chart, if this moved from 131.09 down to 130.12 is just 1 bar, whereas on a range-based chart, it's 1, 2, 3, 4, 5, 6, 7, 8, 9 bars. But that being said, I do look at both charts, because sometimes you're going to get insight into market activity on a range-based chart that I'm not going to see on a time-based chart, and and again, vice versa. Which one is better? Well, it all comes down to what you want to see on the chart, and what's important to you in the order flow, right? Order flow is just not looking at the bid ask or looking where resting liquidity is. There's order flow is so robust. You can take into account point of control, imbalances, delta, and there's just so many different ways that you can be using this information. And sometimes you're going to see things on the range-based chart that you might not pick up on a time-based chart. Okay, especially if a market is dead in the water. Unfortunately now, we don't really get those quiet periods in these markets. Markets tend to move pretty quickly. And, that being said, especially in volatile markets with rapid price movements, range-based charts may be more responsive as they adjust faster to, prices going up or prices going down. Whereas, on a time-based chart, it's just going to stay in the same bar. Whereas on a range-based chart, you're going to get a lot of bars starting to print. Okay, so that's how when I say it's a little bit more responsive, that's what I mean. But you're going to be looking at the same things, whether you're looking at a 1 minute chart, 5 minute chart, 5 range chart. So let me just duplicate this chart, and we'll take a look, sort of at them side by side. Actually, I should have opened this in a new window. Let me just do that real quick. I'll change this to a 5 minute chart. So I got the 5 range chart here, and let's put them a little side by side so you could get a better, sort of a better glimpse here. Come on, get up there. Expand this down. Expand this down. Whoops, that's the old chart from 2015, 7 years ago. You can see how different the Orderflows Trader software looks now. It was just the basic plain footprint back then. Now we've got a lot more information right now, but what I've got is just the normal footprint. So let's just go back here to this time here at 8 o'clock. Okay, go back here to 8 o'clock. So this is a 5 minute chart here. This is a 5 range chart. And again, you're seeing on the 5 minute chart, right? You can see obviously the longer bars, the shorter bars, whereas on the 5 range chart, everything is it's pretty set, right? Honestly, on this here, let me turn on some things here so we get a better clue as to how this market is moving. Now we turn on the simple thing, stacked imbalances, volume imbalance. Where are you here? Just so you can see here, that's multiple imbalances. There's so many things in here. Here we are, stacked imbalance. Okay. Then I'll open it up here just so you can see what I'm talking about a little bit better. And we'll just sort of compare some of these things, sort of what we're seeing here in the market. Okay, stacked imbalance here. So obviously, the bars are formed differently. Volumes in the bars are going to be different. You can see here, this is at 8 o'clock, the high 64.91. This is a green bar. You get that high up there on the green candle, and the market starts coming off. Here it's actually on a red candle, right? And then the market starts coming off. What you see right after we put in this high here on the 5 range is a stacked selling imbalance. You don't see that coming in here on the 5 minute chart. A little bit later, a few ticks lower, coming in at 22 to 20, you've got a stacked selling imbalance. But you don't have that coming in here at between 22 and 20. You still have that selling imbalance coming in here, the 226, but you don't have those other imbalances, because within that range, it was trading back and forth. It's almost like the top of this bar here, these two bars is combined, is kind of what you're seeing. But again, if you're just looking at stacked imbalances, well, on the range-based chart, it's coming in a little bit quicker. You're not seeing it in here on the time-based chart. Okay, just sort of scroll over here. Now, this is coming in at 9 o'clock. Okay, what we have here, let me just turn this on, is what we call a prominent point of control. All right, prominent point of control is a point of control that's acting as support or resistance. Let me just enable that one on. And, I'll just make it until tested, so it stands out a little bit more. Okay, right there. I'll turn it on here on the 5 minute chart. Prominent point of control. There we go, until tested. And this is a prominent point of control. It's indicating that there's resistance here, right? You don't see it coming in, even though it's the same volume in here, 13 and 171. Why? Because in this bar, this is a 5 range chart. So, the bars are going to be a little bit smaller. Market starts selling off. here is just mixed in with this bar, right? Here I've got a bullish prominent point of control, this magenta prominent point of control coming in at, that's at 840. But in the range-based chart, it's just sort of combined in this one bar, right? What you're seeing with this 1, 2, 3 price levels here at 08, right here at 08 on the range-based chart, right? Since we're sort of going sideways in here, you know, this area between, you know, 130 11 and, you know, 130.07, you know, right in here, it's formed in one bar. But on the 5 minute, you know, 5 minute ends, got to start a new bar. 5 minute ends, got to start a new bar. 5 minute ends, it starts a new bar. Whereas here on the range-based chart, it's just all combined in there. Okay, so here you do have a bullish prominent point of control, but you don't have the bearish prominent point of control. So, you know, there's, like I said, there's advantages and disadvantages. Sometimes you're going to see things on the chart, you know, the time-based chart that you're not going to see on the range-based chart. So, for example, here's a bullish prominent point of control coming in at 1030, right? And you get this little bit of a move up from, you know, basically 04 up to 08. Whereas on this chart, right, you can see this market is very quiet now, right? It's quieted down. Most of these bars are just trading, you know, the bid offer plus one tick above or one tick below, right? It's 3 ticks. Whereas here, so this is 1030 to, you know, 1055, okay? 1030 to 1055 on the 5 minute chart. Well, here on the 5 range chart, basically 1030, this is 2 contracts up here, that's the 2 contracts up there, is, you know, basically it's this one bar right here. It takes about 15 minutes to form. Okay, whereas, so you're not going to see this trade here that you're seeing on here, and you're seeing buying and balance, buying and balance, buying and balance, buying and, you're seeing it from down here, buying and balance, buying and balance, buying and balance. So you know there's some aggressive buying going on. Whereas on the range-based chart, you know, from 1020 right in here, you're not seeing those buying imbalances. Okay, then you start seeing the selling imbalances come in here, and the market just sort of goes sideways. Whereas here, you know, this is, you don't see the selling imbalances come in. It's not till 11:43 that you see some strong selling coming in. You know, on this 11:43 here, you've got this stacked selling imbalance. So you're not picking up necessarily, right? If you watch the point of controls where volume or balance is taking place in the market, right in here. I mean, this is obvious if you're watching. If you're watching the point of controls in the order flow on a time-based chart, you see 2 get aligned up here. Then you got 1, 2, 3, 4, 5 at 03. Basically, we're trading 03 for 30 minutes. Then we start to break down below it, and you got a stack selling imbalance, which is a strong signal that, hey, you know what, we could probably punch a little bit lower. Okay, but it just, you get the stack selling imbalance, goes sideways before it sort of drops another 5 ticks. But on here, you just see it as one bar. Right, you're seeing all these bars, 1, 2, 3, 4, 5, 6 bars basically coming in this one bar. So here you're seeing that stack selling imbalance, but you're not necessarily seeing it here on the range-based chart. Okay, so again, you know, there are certain things that are unique to different types of charts, right? Time-based chart, obviously, it's going to be based on time, and as soon as that time is over, it's going to form a new bar, period. Okay, but it leaves footprints like this, so to speak, because this is a footprint chart, you know, where you're seeing over time the market balanced. But on the range-based chart, you might not pick it up. I mean, you know, unless you're really paying attention, you know, you think it's a slow period. Obviously it is, but this one bar, you know, opened up basically 11:16 and ended up at 11:43. So, you know, you're talking, you know, close to 30 minutes, right in here. But if you're looking at this time-based chart, you're saying, oh, you know what, we're just going sideways in here. We're putting in a balance area. Maybe I could watch it when it breaks out. Whereas here, you know, maybe you're not paying as much attention to it. Okay, but once the market starts moving, you know, on a time-based, on a range-based chart, sometimes it's a little bit more obvious because you're going to start to see more bars forming, you know. Here, right, go back to this 9 o'clock, right, 9 o'clock when it's got this one bar here, And you say, wow, it's a big bar down. But if you're watching it here at 9 o'clock, you're seeing 1 bar form, 2 bars form, 3 bars form within the 5-minute period, whereas here it's just, 1 longer bar. So I look at both of them. Honestly, I don't want to say that I don't look at a range-based chart or I only look at a time-based chart. There's information, there's tradable things in both of them. Whether I'm looking at prominent point of controls or, another thing I like to look at is the value areas. Okay, so let's throw those value areas up on here. Okay, I'll just throw up the plain value area. So that's on the range-based chart. Now the value areas, this is something that's on the Orderflows Trader 6. And again, it's very useful for helping identify when a market is, moving away from balance or from value, however you want to describe it. I use the term balance and value pretty interchangeably. Okay. Okay, so let's just go back to this 9 o'clock time. Okay, so this is the bar here on the 5 range. This is that same bar at 9 o'clock on the 5-minute chart. Now, what I see here, right, this is the value area, this red area of the bar, because it's a red bar, so it's printing it red. The green bars, it prints it green. And what I'm seeing, while this is a bearish value area, it's taking place in that 1 bar. Okay, here I can see it's bearish, it's bearish, it's bearish in the sense that I have a gap between this value and this value, this value and this value. Here I just have it in that 1 bar, then it just sort of starts to overlap. Let's go back to some of these higher areas. The time is 7:57. Let me just go back to around this, just before 8 o'clock in here. Okay, this is that stacked selling imbalance coming in at 22. So that's right over, this is 21, this is 22. While this is kind of a bearish looking value area, it's not as clear as what I'm seeing taking place on the range-based chart, right? Because I'm seeing a gap between this value area and this value area, right? And obviously another gap down here. Anytime I have a gap in value areas, it's telling me the market is, potentially getting ready to make a move. Let's just expand on the value areas a little bit further. Again, I'm just comparing the 5 range to the 5-minute chart. I'm not really getting into much deep analysis because, looking at the type of chart, deciding on the type of chart that you want to use or, what you want to look at for things, is a personal decision, right? It's not like, oh, well, Mike says I got to use a 5-minute chart or a 5 range chart. No, look at the charts. If it's easier for you to see things on a 5-minute chart, then use the 5-minute chart. If it's easier for you to see things on a 5 range chart, then use the 5 range chart, right? Trading is kind of a personal endeavor, right? You got to find what makes sense to you. Look at the market in ways that it makes sense to you. Okay, so here, right, this is 9. This is what we call the EVA, right? The expanding value area. It's a bullish sign. On the 5-minute chart, I've got a bearish one here, a bearish one here, then a bullish one here. On the 5 range chart, I don't have it here. This is at 9 o'clock. That's at 9 o'clock. This one came in at 9:20. I don't have it at 9:20. There's the bullish one here. It just sort of went sideways afterwards at 9:40. But I don't have any on the 5 range chart here. But on the 5-minute chart, I've got this one, and this one that just went sideways. So again, you're seeing things on different types of charts, but you'd still look for the same things, right? Just because you're looking at a 5-minute chart doesn't mean you're not still paying attention to that same thing on the 5 range chart. It's just for some people, it's a little bit easier to pick things up on a time-based chart. and for others it's a little bit easier on a range-based chart. Again, this is the 5-minute chart. This is the day before, the Thursday, right? The bearish value area, right? You can see it's just sort of a little bit lower. I'm not saying, oh yeah, big sell-off. No, it just sort of hung around there, and moved down. Whereas on the, let me close this one down, go back here, just go back to the previous day. This is the 5 range chart on the 8th. Yeah, I mean, you don't have it there, right? You got some imbalances, but on the range-based chart, you don't have those bearish value areas. Right, these are just stack selling imbalances coming in right when the number came out on Friday. So again, is there one right or wrong chart to look at? No, right? You find the chart that makes reading the market easiest for you. That's what it comes down to. So I hope this answers that original question. It's kind of a, I'll say, hard question to answer specifically to a specific trader. It takes time to pick up things in the market, what you're going to focus on. And again, sometimes it's easier on a range-based chart. You're going to see things that you might not see on a time-based chart, and vice versa. All right. So again, guys, if you got any questions, be sure to put them in the comment section, and I'll get to them in time. Sometimes now I'm going to try and make videos on them. It's a little bit easier than typing it out. I've got a few other questions I want to get to in some later videos. About settings. What's a good setting for 10 years or mini Dow or gold. But again, it really depends on the type of trader you are, right? Not everybody trades the same. Not everybody has the same, what is that? Same risk tolerance. Some people could take a drawdown of $500, or some traders drawdown of $200. They're already sweating bullets. So it really depends on yourself as a trader, what your risk tolerance is in a certain market, and that's going to help you determine what type of chart you're going to look at. Okay, because there's no right or wrong answer. That's what kills me the most. If you read Market Wizards, right, all those guys, they got different ways of trading. They're all brilliant traders, but they look at the market through different lenses. Right? Some people, some guys were on the floor in that book, so they got a very short-term view. Other guys were macro guys. They have a very long-term view. Is one way better than the other? No, it's one way is what's best for you individually, right? And that's the thing is, sometimes people like to try and force themselves into, think of it like those kids' toys, right? The box with the square, the triangle, and the circle, right? Sometimes it's like trying to fit a square peg into the circle hole. It's just not going to fit. And, it's trying to force yourself into being a certain type of trader in a way that's not natural to you is, a recipe for disaster. So I hope you guys like this video. Be sure to like and subscribe, and keep those comments positive, and comments, in the videos. And if you got questions, and hopefully I can get to them. So hope you enjoyed this video, guys. I'll see you guys on the next video. Bye-bye.